There's a phrase in the stock market that the market and the economy are not the same thing. And that might be true on a day-to-day basis, might be true on a week-to-week basis, even on a monthly basis at certain times. But over time, there's no doubt that these two things move together. The stock market wants you to believe that it is always ending. And right when it convinces you that the stocks are going to go higher, that's when it turns around and goes lower. But the overall trend is higher. We are continuing to be in expansion. The S&P will be higher at some point than it was in January, at some point during 2018, probably into 2019. My name is Carmel. I'm based in San Francisco. I'm an investor and I'm a writer. I write a blog called The Fat Pitch, and I've been an active investor and an analyst going back to the early 90s, so about 25 years. So let's talk about the stock market and how the stock market works in a very aggregate basis. So think about the analogy of a novel being written. So let's take a mystery novel, for example. So it starts with a murder, and 400 pages later, it ends with the resolution. The murderer has been caught and the murder has been resolved. So that is a narrative, and it goes from point A to point B. And if the author wrote the story that way, it would be the worst book of all time. Nobody wants to read a story where they know what the ending is. So what happens along the way is that first you think that the wife did it, and then you think that the son did it, and then it's the neighbor, and the story swings from left to right, always keeping you off guard. Why is this relevant? The stock market is very similar to that. It follows a basic narrative. The narrative begins with the end of a recession, and it ends with the beginning of the next recession. That is the basic narrative of the market. And in between the beginning and the end, the stock market goes up. So the stock market bottomed in March 2009, and it continues to rise. And along the way, the market has swung. The market has kept investors off their foot or off balance the entire time. It goes higher, and everybody expects it to go higher. And when it does that, the market turns around and it falls 10%, or it falls even 20%. And then everybody thinks that the bull market has ended and that it's going to go back down to the 2009 lows. And then it swings up and it goes higher again. That is basically what the function of the stock market is. The stock market wants you to believe that it is always ending. And right when it convinces you that the stocks are going to go higher, that's when it turns around and goes lower. So why is this relevant? It's relevant in that people... There's a phrase in the stock market that the market and the economy are not the same thing. And that might be true on a day-to-day basis, might be true on a week-to-week basis, even on a monthly basis at certain times. But over time, there's no doubt that these two things move together. The stock market bottomed when the recession ended, and it continues to move higher. So that tells us something about how the stock market works. It tells us that if you want to understand where the long-term trend, you need to start by understanding where we are in the economy. Are we still in an expansion, or is that expansion ending, or has it already ended, and are we heading back into the next recession? I think that is the basic thing that every investor needs to understand. So we usually start by getting that perspective straight for investors. So where are we today? We are still in an expansion. The economy is continuing to grow. The stock market, at the most broad measure of the stock market, which is the S&P 500, made its most recent peak as recently as 4 months ago. It is around 3 to 5% below that today. Other parts of the stock market have made highs subsequently in March, and even as recently as last week, the small cap index were at a new high. But the overall trend is higher. We are continuing to be in expansion. The S&P will be higher at some point than it was in January at some point during 2018, probably into 2019. Beyond that, nobody can tell you where the market's going to be. But we have not seen the ultimate high in this market. We will continue to go higher. Why do we believe that that's the case? Let's talk about a couple of different things. First of all, getting back to the economy. So how does the economy work? The US economy is 70% driven by consumers. So consumers are going out and shopping. The rest of the economy is the government and corporations investing. And then there's a component of it which is housing demand. So consumers are continuing to get new jobs. The unemployment claims in the middle of May hit a 49-year low. So unemployment continues trends down, employment has continued to trend up, wages are growing at around 3% per annum. What does that mean? That means that Mr. Consumer has got more money in his wallet. That means that he can go out and spend more money every week and every month. That means for corporations need to continue to invest in their businesses. They need to continue to increase supply, put new or more people into shops to work. So corporations continue to invest in their operations. That in turn, of course, creates more employment. So as more people get employed, more people have money, more people can spend money. All of that is very productive for the long-term trend of the economy. And in fact, we see that in the figures. We continue to see retail sales that are going 2 to 3% in real terms higher every single year. We see GDP growth of about 3% real per annum. We continue to see consumers spending money. Housing sales. When consumers get more money, they of course invest in real estate, they move into homes, they form households. And new home sales continue to trend upward. We recently had a new expansion high in the number of homes being sold. The number of permits being issued by builders or by authorities for builders is reaching an expansion high. The number of new starts in housing is reaching an expansion high. So these things are all very favorable to the economy. And there are reasons to believe that the ultimate high in terms of the economy and therefore in the stock market has not yet been reached. Along the way, like I said, the stock market wants you to believe that anything except for higher highs are ahead. And in fact, the current period, in fact, 2018 has been a pretty good example of that. So, heading into this year, the stock market last year had been up around 15%. It had marched steadily higher. And by the end of the year, people had gotten pretty bullish. You can look at various sentiment indicators, put-call ratios, for example, or you can look at a survey done by, for example, the Investors Intelligence, which looks at newsletter writers, and many of those things had reached pretty significant highs heading into January. So it was not a big surprise that we formed an intermediate peak in January. Investors had just gotten too bullish, and when everybody's expecting higher prices, the job of the stock market is to confuse you and to lead you into believing that a different narrative is taking place. So the fact that the stock market fell at that point kind of made a lot of sense. And it's been basically treading sideways ever since. It went all the way up, and then it fell 10%. And then we've basically been trading in between that high and that low ever since. It's a consolidation. How long do those consolidations last? In the past, they've lasted as long as a year. You can easily have a 6-month consolidation period. So we could be in a period where we continue to see the market trade between the high and that low going into the summer. In fact, in pre-election years like we are today, in this year, there's an election coming up in November, it's very common for the stock market to trade sideways. This is one of the weakest years in that 4-year election cycle. And that cycle tends to be pretty weak until September. And about a month to 2 months before the next election, it finally forms a bottom. It finally starts to reestablish the primary trend. If you're looking for a rough roadmap for what might be happening over the next couple months, that's not a bad one. So continue to see weakness and volatility into the summer, and then the market forming a low and then rallying into the fourth quarter of the year. That would probably be a pretty good way to expect the market to behave over the next couple of months. Let me talk a little bit about how stock market patterns typically work. So let's go back to 1980, so over the last 37 years. Over that period of time, the stock market has been up 80% of the time. If you go back to the 1950s, the stock market has been up around 72% of the time. So that means that the stock market rises 2 to 3 or 2 to 4 times more often than it's declining. So the stock market has a long-term propensity to rise over time. It rises by a median of about 10 to 12% per year. And that means that going into any particular year, investors, as long as the economy is doing well, should be biased towards higher price. One of the things which investors typically get wrong is they think that the market is symmetrical. They think that it spends an equal amount of time going up and going down. And that's clearly not the case. It spends a minority of its time going down. If you go back even over the last 190 years, which includes many, many very volatile periods of time, the number of times that the market has been in a bear market, in other words, that it falls 20% in a year, is 5%. So the overwhelmingly highest proportion of the time, the market is trending upwards. So people should be expecting higher prices over time. In the span of any particular year, a drawdown is normal. So investors should be expecting about a 10% drawdown every single year. That is a very typical amount. And so this year is very average. We've had a 10% drawdown so far. That means from the high to the low within the course of the year. And so this year is very normal. You can have a drawdown as much as 15% during the course of a calendar year. And that is within a 1 standard deviation. In other words, that is within the normal range. So what we're seeing so far in 2018 is very typical for any year within an expansion. What we're seeing is nothing unusual. So again, these are the overall sort of waves up and down within the primary narrative of a market which is going higher. There are things which investors should worry about, and there are things which are frankly irrelevant to investor returns. And let's talk about some of those things because they come up very frequently in market discussions. Let's start talking about valuation. So investors tend to focus on PE ratios as an example, and assume that very high PE ratios imply that the market is going to be going down. In fact, the correlation coefficient is extremely low. In the course of 1 year forward returns, only about 10% of the return in the stock market is explained by valuations. In other words, 90% of the stock market is explained by other things other than valuation levels. So valuations themselves tend not to be a particularly good indicator of what the stock market's going to do over the next year. Even over the next 3 years, it's not a particularly great indicator of how the market's going to do. Only about 45% of the return in the market is explained by valuation. So more than half the returns in the market are explained by other things. And I would say that those other things are, for example, sentiment as well as the macro picture. Again, focusing on the long-term trend, the long-term narrative is where investors make the most amount of money. Why focus on macro indicators? Well, there's a couple of reasons why I think that's important. First of all, if you look back over the last 70 years, there have been 10 recessions. In those 10 recessions, there have been 9 bear markets. So recessions and bear markets tend to go together. Most of the bear markets that investors that are alive and trading today have occurred within the context of a recession. The exceptions are very few. 1966 is one exception to that. In 1966, the Fed got caught behind inflation. Inflation went from 1% to 3.5% within a very short period of time. The Fed funds rate went from 4% to 6%. That caught investors off guard, and the stock market slid into a bear market without there being a recession. That was a good example of the Fed making a mistake in terms of setting expectations with investors, and investors kind of responding by putting the stock market into a bear market. The other great exception is, of course, 1987. And if you always wonder why 1987 is brought up as a good analogy for what's going to happen in the stock market this year or starting this month. Why is that? Well, the reason is because it's the only example in the last 30 years, in fact, in the last 50 years, where the market has very suddenly slid into a bear market without there being any warning. But it was under very, very different circumstances than we have today. In the 10 months leading up to that August 1987 peak, the stock market had risen 50%. So investors have gotten very, very bullish in a very, very short period of time. And then the market, of course, peaked out and then it fell. But other than that, in the last 50 years, you have not seen the stock market go into a bear market without there being a recession. So let's talk about macro. Let's talk about some of the things which make a difference. So now one of the knocks on macro is that people say, hey, why do I need to follow macro? Price of the stock market usually peaks a couple of months before the economy tips into recession. In other words, investors anticipate a recession and start to sell off stocks. That is very true. In the last 40 years, the stock market has peaked around 7 months before the beginning of the next recession. So that has been a very good leading indicator. The thing is, the stock market has fallen at least 10% about 35 times in the last 70 years. So the stock market tends to fall a lot, and we don't know in real time which of these corrections is going to become a bear market. There's been 10 bear markets, but there's been 35 corrections. So which of these is going to become bigger than 10%? 10% is a very typical fall within the course of any particular year. So how can we distinguish these two things? Well, there are things within macro that can give us a leading edge on whether the economy is starting to soften. And there's a couple things that we've identified that we think are important. Number one, unemployment claims. So again, getting back to the economy, as long as people are working and new jobs are being created, that tends to be good for the long-term prosperity of the stock market. And that, in fact, tends to peak before the stock market. So in other words, unemployment claims should start to rise up again before the stock market makes its final peak. Unemployment claims were just at a 49-year low 2 weeks ago. So it's probably too early to say that that has bottomed out. That should bottom out probably about 10 to 12 months before the next recession. Secondly, the yield curve. So the difference between, for example, the 10-year Treasury and 2-year Treasuries tends to invert. In other words, it tends to go negative about a year to 2 years ahead of the next recession. Right now, that yield curve is still positive by about 50 basis points. And so that's a second thing which is indicative of a coming recession, is that the bond market is sensing weakness in the economy, and the bond market is responding by having those yields invert. We have not seen that either. So we haven't seen unemployment claims bottom yet, and we haven't seen the yield curve invert yet. So that's the second thing. And the third thing is new home sales. New home sales tend to be the longest leading indicator. They tend to peak during an expansion about 2 years in advance of the next recession. Well, we just had a high in new home sales just 5 months ago. So it's too early to say that that is going to be the ultimate peak. The new home sales in April were only a smidgen below that peak in November. So new home sales tend to be, or continue to be, very strong. So those three things, new home sales, the yield curve, and unemployment claims, tell us that we are unlikely to have seen the expansion high, and that means that we're unlikely to have seen the high in the S&P. So those continue to go higher, and that is in response to a strong economy. That, by the way, on its own should tell you that the economy is doing well and that the Fed continues to see expansion. The fact that they continue to raise rates suggests that they see growth continue to trend higher, that they continue to see employment trending higher. The stock market in the last 40 years has not peaked until the last rate hike has already taken place. So we have not seen the last rate hike. And in fact, we've already seen a rate hike after the S&P peak in January. So unless this cycle is different in some way, we should see the S&P peak after the last rate hike. How does the stock market typically respond to rising rates? It responds very well. So if you look back over the last about 70 plus years, there have been 12 rate hike cycles where the Fed has been raising short-term rates, and the stock market has risen on an annual basis 10 out of those 12. So it's about 83% success ratio, and it's risen about 10% per annum during that period of time. So that might sometimes be confusing to investors. They might think that, well, if rates are going up, investors are going to switch to bonds, and that should be bad for equities. That's a very that's a point of view that's taken place because rates have been going down and the stock market's been going higher over the last 35, 40 years. And people tend to think back to the 1970s when rates went up very high and the stock market did poorly. That is more of an anomaly than it is sort of the typical market behavior. Typically, these things tend to move together. So if you were an investor sitting in 1980 and you look back over the prior 30 years, back to the 1950s, for example, you would have seen rates going higher and the stock market going higher. And that made complete sense to everybody at that time. Why does it make sense? Because, again, rates indicate that the economy is expanding. It indicates that employment's getting better, that more consumers are out buying, and that indicates higher prices, higher margins, higher sales, all of which are very good for the stock market. So these things tend to move together. And so what we're seeing now is very typical for behavior between the bond market and the stock market. So investors tend to get very concerned about debt levels, and it's not surprising because you see this information in the news all the time, that the federal government is running huge deficits, that it's adding to its debt, that the debt is now larger than a year's worth of GDP, that households are running up a lot of debt, that corporations are selling stock and taking on debt, all of which sounds very concerning, very bearish. And I think just as a human nature is to assume that more debt is going to be a negative. I have the same feeling when I hear these stories and when I read these stories. The truth is that we have to look at these things objectively. We have to look at them quantitatively. And the truth is a couple of things. First of all, the most important debt figure to be looking at is consumer debt. And because the consumers are 70% of the economy. And the reality is that consumer debt continues to be quite low. Consumers have about 5 to 7 times more assets than they have debt right now. So in other words, their asset coverage on their liabilities is very healthy. Consumers' debt servicing, in other words, the amount of their income that they're spending servicing their debt, is at roughly a 35-year low. So consumers are not stretched in terms of their ability to borrow. In fact, one of the things which has been interesting about this cycle is that consumers have not been leveraging up. Consumers seem to have learned from the last cycle that they don't want to be over leveraged into a top, and so they've been very careful to not take on too much debt this cycle in comparison to other rate cycles. Corporate debt has really been very consistent over the last 25 years. Just going back to a little bit of market history, corporations geared up in the 1980s, and that peaked around 1992, roughly. And since then, corporations really haven't changed their debt levels. It's been very consistent over time. Their debt to their assets has been, throughout that period of time, about 5 to 6 times. So corporations do have more debt than they used to, but really no different than it's been any time over the last 25 years. So I think corporate debt also is very well covered by assets as well as by their income. And then finally, there's the federal debt, right? So federal debt, like I mentioned, is about 100% of GNP right now. And that has been a concern which has been raised. GNP is not a particularly good way of benchmarking federal debt. You do not pay the debt with GNP. You do not cover the liability with GNP. You cover those things with income and with the assets that the government owns. The government owns oil reserves about 8 times larger than all of the debt that it has. It has coal reserves that are equal to the amount of debt. It has enormous real estate holdings. So the government has huge assets relative to its liabilities. It's not overextended from a liability standpoint. And if you look at debt servicing payments as a percentage of federal income, it's still very small. It's, as low as it's been in, for example, the 1950s. So the federal government is not spending an inordinate amount of money on servicing the debt that it has right now. So it's easy to get concerned about debt. It's easy to see that these things are going to be an impediment to growth. But the reality is that investors have been focusing on debt at least for 25 years. As long as I've been in the market, investors have been fretting about too much debt at all levels of government and in corporations and in households. And none of these things have made a difference to growth, and none of these things are likely to make a difference to growth, at least over the foreseeable future. So to summarize, the most important thing for investors to focus on is the main narrative of the market. Where are we in this long narrative? And in our view, the data clearly points to continued expansion. So investors should expect to see higher equity prices at the end of this year, probably into 2019. Beyond that, frankly, it's difficult to know. We don't know what the forward economic data is going to be. Right now, it looks very promising, but let's be honest, we don't know what that's going to be. But for the foreseeable future, it looks like the stock market will continue higher. Over the next couple of months is frankly anybody's guess. It's very difficult to guess the direction of the market over shorter periods of time because these things are subject to the whims of investors and to sentiment. Sentiment has been reset over the last couple of months, but sentiment could be reset even lower. I mean, investors could become much more bearish than they are today. That could pull the stock price lower than it is today. Any of these scenarios is possible, but we think that if you look over longer periods of time, you're likely to be rewarded by investing in the stock market on these weaknesses. We don't think that you've seen the final peak in stock prices and that you're likely to see higher highs as the year closes out.